Donald Trump has made it clear he wants lower interest rates. But what does that actually mean for your wallet, the stock market, and America's future? Think about it. Interest rates affect almost everything around us, from the price you pay for a mortgage to the cost of your car loan to the strength of the US dollar. Interest rates quietly shape the economy in ways most people don't even notice. When they fall, life can suddenly feel easier. Money flows more freely, markets rise, and businesses expand. But here's the catch. Those short-term wins often come with long-term risks. Inflation, debt, bubbles, and financial instability can all sneak in when interest rates stay too low for too long. So what happens if Trump keeps pushing for rate cuts? Will we see an economic boom, or are we walking straight into a financial storm? Stay with me, because in this video, we're going to break down exactly what could happen to your wallet, the housing market, the stock market, and even America's role in the global economy. And trust me, you'll want to hear both the good and the bad. Interest rates are, at their core, the price of money. When you borrow from a bank, you're paying for the privilege of using their money, and the rate tells you how much that costs. When you save money in a bank account, that same rate determines how much the bank pays you in return. It sounds simple, but this number quietly influences almost every decision in the economy. Think of it this way. If interest rates are high, borrowing is expensive. Businesses hesitate to take loans, families think twice about buying a home, and people are less willing to swipe their credit cards. Spending slows down and the economy cools off. But if interest rates are low, suddenly everything changes. Mortgages become cheaper, car loans look manageable, businesses borrow more to expand, hire new workers, and build new factories. People spend more, companies grow faster, and the economy seems to come alive. On the surface, this sounds like a win-win. More growth, more jobs, more money in circulation. Politicians love low interest rates because they often lead to short-term economic boosts and happy voters. It's no surprise that Trump has openly pushed for lower rates, criticizing the Federal Reserve whenever it kept them higher than he wanted. But here's the problem. Cheap money isn't free money. Lower rates might stimulate growth today, but they can also sow the seeds of tomorrow's problems. Inflation, asset bubbles, and unsustainable debt are the hidden costs of easy credit. And once those problems start building, they're much harder to contain. So when Trump talks about continuing interest rate cuts, he's essentially saying, let's make money cheaper, let's fuel growth, and let's keep the economy booming. And while that may sound appealing, the real question is, what happens after? Because every interest rate cut comes with a trade-off, and understanding those trade-offs is the only way to see the full picture of what this policy could mean for America's future. Cheaper loans and mortgages. Good news for anyone buying a house or starting a business. That's one of the first things people notice when interest rates go down. Imagine you're looking at a $300,000 home. At a higher interest rate, say 7%, your monthly mortgage payment could be crushing, maybe well over $2,000. But if rates drop to 4%, that same house suddenly looks affordable. Your payment shrinks, you qualify for a bigger loan, and you feel wealthier without earning a single extra dollar. That kind of shift doesn't just affect you. It ripples across the housing market. More buyers jump in, sellers can raise prices, and construction companies rush to build new homes. Realtors, banks, and furniture stores all benefit. This is why politicians love low rates. It makes people feel like the economy is working for them. And it's not just homes. Businesses thrive on cheap borrowing too. If you're a small business owner thinking about expanding your bakery, adding a new location, or hiring more staff, low rates mean the bank is more likely to say yes, and your monthly payments won't eat up your profits. For large corporations, low rates can fund massive investments, mergers, and research. That activity fuels jobs, wages, and consumer confidence. Then there's the stock market. Historically, when rates fall, stocks tend to rally. Why? Because investors are always chasing returns. If interest rates are high, safe investments like bonds and savings accounts look attractive. You can park your money and earn a decent yield. But when rates drop, those safe havens stop paying much. Suddenly, stocks, real estate, and even riskier assets like crypto start looking more appealing. Money flows into the market, share prices climb, and investors cheer. This is one reason Wall Street often loves Trump's talk of lower rates. It means more fuel for stock prices, higher valuations, and, in the short term, bigger profits. If you've ever looked at your 401k or investment portfolio during a rate-cutting cycle, you probably notice it growing faster than usual. Another short-term effect is on the US dollar. Lower rates typically weaken the dollar compared to other currencies. For exporters, this is a gift. If you're selling American-made cars, machinery, or technology overseas, a weaker dollar makes your products cheaper for foreign buyers. That can boost US manufacturing, create jobs, and improve the trade balance. Trump, who often talked about America needing a more competitive dollar, knows this dynamic well. For the average American, all of these effects combined can feel like a rising tide lifting all boats. Houses are easier to buy, stocks are going up, jobs are plentiful, and even exports are more competitive. It's the kind of environment where people feel confident, spend more freely, and give credit to whoever is in the White House. And that's the political magic of interest rate cuts. They create visible, tangible benefits that show up quickly. Within months, people notice cheaper loans, booming markets, and an economy that feels alive. But here's the catch. These benefits often come with an invisible timer, because while things might look great in the short term, the longer rates stay too low, the more cracks begin to form beneath the surface. And those cracks, that's where the risks start creeping in. But with more money flowing around, inflation could rise again. And this isn't just an abstract number economists argue about. It's something you feel directly in your daily life. Think about the grocery store. When rates are low, demand for goods increases because people have more money to spend. But supply can't always keep up. More buyers chasing the same loaf of bread, the same gallon of milk, the same car or apartment, that pushes prices up. Suddenly, what used to cost $50 at the store now costs $65. Inflation eats away at every paycheck, and that so-called cheap money doesn't feel so cheap anymore. We've already seen how quickly inflation can spiral. After years of low rates and pandemic stimulus, prices for everything from gas to rent jumped. The Federal Reserve had to slam the brakes with aggressive rate hikes just to cool things down. If Trump continues cutting rates in an environment where inflation isn't fully under control, we could find ourselves right back in that same cycle, short-term relief followed by higher costs of living. Then there's the risk of asset bubbles. Cheap money has a way of finding its way into investments often faster than the real economy can keep up. Take housing, for example. If mortgages stay cheap for too long, demand keeps rising, home prices shoot up, and before you know it, affordability collapses. People stretch their budgets, investors buy properties they can't really manage, and the market inflates beyond reason. When the bubble bursts, ordinary families are left with underwater mortgages and shattered savings. The stock market faces a similar risk. Investors chasing returns can inflate prices far beyond what companies are actually worth. We saw this in the late 1990s during the dot-com bubble, and again in the run-up to the 2008 financial crisis, when cheap credit fueled reckless bets. Lowering rates might supercharge stocks in the short run, but it also sets the stage for painful corrections down the line. And let's not forget crypto. Every time rates fall, speculative assets like Bitcoin tend to surge. That can create a frenzy of hype and investment, but it also leads to dangerous levels of volatility. When money gets too easy, people stop asking whether an asset is really valuable. They just chase the momentum. And history tells us momentum can turn on a dime. There's also a quieter group of Americans who suffer when rates are low: savers. Retirees living on fixed incomes often rely on interest from savings accounts, CDs, or bonds. When rates are cut, their earnings shrink dramatically. A retiree who once lived comfortably on interest income suddenly has to dip into their savings just to cover expenses. It's an invisible cost that doesn't make headlines, but it's devastating for millions of households. This is the cruel irony of rate cuts. They feel like a gift to borrowers, but they act like a punishment for savers. The economy tilts in favor of debt over discipline, borrowing over saving. And while that imbalance can keep the party going for a while, it makes the system more fragile. So in the medium term, the risks begin to show. Inflation starts creeping back, assets become overpriced, savers get squeezed, the very policies that seem to create prosperity begin to undermine it. And that leads us to the deeper, long-term dangers, consequences that can reshape not just your wallet, but the entire foundation of America's financial system. More debt. That's the unavoidable outcome of prolonged low interest rates. When money is cheap, governments borrow more, businesses borrow more, and households borrow more. It feels painless at first. Why not take out a bigger mortgage if the payments are manageable? Why not issue more government bonds if investors are lining up to buy them? But debt is like gravity. It never goes away. It only gets heavier over time. For the U.S. government, this is particularly dangerous. Washington already runs trillion-dollar deficits year after year, and the national debt has ballooned to record highs. Cutting interest rates makes borrowing easier in the short term, but it also encourages more spending without discipline. Eventually, those debt levels become so massive that even small shifts in interest rates or small drops in global confidence can shake the entire financial system. For households, it's a similar story. Families that overextend during low-rate environments can find themselves trapped when rates eventually rise. Imagine buying a home or maxing out credit cards because borrowing was cheap, only to discover later that wages aren't keeping up with rising costs. Debt burdens grow, defaults increase, and the cycle of financial pain spreads across the economy. But debt isn't the only long-term risk. Another problem is that low rates rob the Federal Reserve of its most important tool, flexibility. Think of interest rates as the Fed's brake pedal and gas pedal for the economy. When things slow down, the Fed cuts rates to stimulate growth. When things overheat, it raises rates to cool inflation. But if rates are already near zero or are cut too aggressively, there's very little room left to maneuver. That means when the next recession inevitably comes, the Fed could find itself powerless. We saw a glimpse of this after the 2008 financial crisis. Rates were cut to nearly zero and stayed there for years, leaving the Fed with almost no ammunition when new crises emerged. If Trump pushes rates lower now, we could end up in that same trap, a future downturn with no tools left to fight it.
Then there's the question of credibility. The Federal Reserve is supposed to operate independently of politics. Its job is to make tough, sometimes unpopular decisions for the long-term stability of the economy. But when a president openly pressures the Fed to cut rates, it sends a dangerous signal to the world that America's monetary policy is being driven by politics rather than economic reality. Why does that matter? Because the US dollar isn't just America's currency, it's the world's reserve currency. Global trade, investments, and even foreign governments depend on trust in the dollar and in America's financial system. If international investors begin to doubt the independence of the Fed or the stability of US monetary policy, they might start looking elsewhere. And if demand for US debt weakens, borrowing costs could eventually rise, creating the very crisis the rate cuts were meant to avoid. In other words, the short-term sugar high of rate cuts could turn into a long-term hangover, more debt, fewer tools to fight recessions, and a weaker global reputation for financial stability. Those aren't just abstract risks. They're structural cracks that can shake the foundation of the American economy for decades. So yes, cutting rates might feel good now. It might pump up the stock market, boost housing, and make borrowing easier. But the long-term price, it could be dangerously high. So yes, rate cuts could bring a short-term boom. For many Americans, it might feel like the economy is roaring. Cheaper mortgages, rising stocks, stronger exports, and a sense that money is flowing freely again. Politically, that's powerful. People feel better off, and leaders who deliver that feeling often win support. But the long-term risks, that's where the story changes. Inflation quietly erodes the value of every dollar you earn. Asset bubbles inflate to dangerous levels only to burst later. Savers and retirees get punished while borrowers are rewarded. Government debt climbs higher, households stretch themselves thinner, and the Federal Reserve slowly runs out of tools to stabilize the system. And beyond all of that, there's the bigger picture, the trust the world places in America's financial leadership. If that trust weakens, the consequences could ripple far beyond Wall Street or Main Street. They could reshape America's role in the global economy. So the real question isn't just whether rate cuts will boost growth today. It's whether we're trading tomorrow's stability for today's gains. Are we creating real prosperity or just inflating a bubble that will eventually pop? That's the challenge Trump's approach to interest rates brings to the table. On the surface, it's a quick path to growth. Underneath, it may be a gamble with America's financial future. If you found this breakdown helpful, hit that like button, subscribe for more economic insights, and let me know in the comments, do you think Trump's push for lower rates is good for America or a dangerous gamble?